I get asked all the time, why don't you own SMH? And honestly, fair question. Because this thing hasn't just outperformed over the last decade, it has obliterated everything in its path. We've all lived through a massive growth decade, but SMH wasn't just along for the ride, it was the captain of the ship. We're talking over 300% higher total return than the second best growth ETF over the past 10 years. That sounds like YouTube hype, I know, so don't take my word for it. Let me show you. I jumped out to Seeking Alpha and I created a brand new screen out here, and you can see I already named it. It's right here, the best growth ETF video screen. And right now there's no active filters to make this completely objective. Now we're only going to have two. One of them being, of course, the 10-year total return. That's what we're looking for here. And then the other one, under ETF details, we have to have something we would realistically invest in. So expense ratio. And I'll be honest, there's a Bitcoin one. There's some triple leverage stuff that has hit some home runs, but they're not realistic long-term investing. I think most investors would agree, in order to buy and hold, my hard rule is 0.5%. We're just gonna go with that. So here you have 0.5% expense ratio or less, and then the total returns give us anything from 0% 10-year total return or higher. And we actually have the results right here. We don't have to run it or anything. And when we sort by 10-year total return, you can see that SMH right here is a whopping 1,145%. And SOX is its main semiconductor competition, at least according to most, is 819, making this crazy monster over 300% better than second place. And you can see a lot of our favorites. We have VGT here at 588, XLK and FTech are very good. IGM we talk about all these QQQ, obviously a big one here. We have to go down for you MGK fans, Vong, SCHG, which I love. It's at a solid 362, a little bit shy of SMH, 1Q, and then VUG. We won't go down any further. I know there's a lot of VUG people out there. So here you go, 342. Wowzer. So yeah, it's incredible. I love it. And I still don't own it. Your next question is probably, what's wrong with you? And well, how much time do you have? But in this one, I'll walk you through why I love this total return behemoth and why it's not in my portfolio. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please high-five that like button, subscribe if you haven't already, and drop me a comment below with anything that comes to mind. I'm gonna change the pace in this part of the video. Instead of talking about Seeking Alpha and Snowball Analytics, link still down below if you're interested, I'm gonna talk about my channel membership. So I had a channel membership that gave everyone access to the spreadsheets and extra bonus content, but I didn't like that because I wanted everything to be 100% free for the masses. I canceled it a few months back, but a lot of you longtime members out there were poking me saying you still wanted to support the channel. So everything's 100% free, and it is not necessary at all. But if you do choose to support the channel and go above and beyond, you can become a channel member. Link in the pinned comment below. I appreciate your time and attention either way, and don't sweat it. You know what time it is. Let's grow. SMH Basics. Before we dive too deep into the numbers on this one, let's talk about what SMH is and what it's actually tracking. SMH is the VanEck Semiconductor ETF, and it seeks to track the MVIS US listed semiconductor 25 index. And I figured the easiest way to show this is just to pull up the official index webpage. And this index tracks the performance of the 25 largest and most liquid US listed companies in the semiconductor industry. And it only includes companies that generate at least half of their revenue from semiconductors or semiconductor equipment. And you can see there's some size and liquidity requirements that I'm sure are fairly easy to meet. But one of the major diversifications that I like, because this thing's already pretty concentrated, is that the company weightings are capped at 20%. I know that's still absurdly large, but I'm just thinking of something like Nvidia. And it's reviewed semi-annually in March and September with quarterly rebalances. And that's a pretty typical cadence for an ETF. Now to address the elephant in the room before we dive into the metrics. I don't own SMH because for me, it's too concentrated in one subsector of technology. And to be clear, I am very bullish on semiconductors. I think they'll continue to crush it as AI progresses and the global demand ramps up. But the way I see it, VGT gives me a massive helping of semis and broader tech exposure across multiple industries. And I never thought I'd call VGT a conservative play, but that's exactly what it is compared to SMH. Let's dig into the metrics to see how dominant this thing has been. It's stupid. Key metrics. It's time to pull up SMH and Seeking Alpha to check out the stats. And while we're out there, we're going to compare it to a wide range of growth ETFs, including its primary semiconductor competition. We pulled up SMH here out in Seeking Alpha, the best platform for researching stocks and ETFs. I have a link if you want to try it out for yourself in the pinned comment. I love this thing and used it well before my YouTube channel. And out here on the summary tab, the first thing I like to look at is down here at the expense ratio. Now, 35 basis points for a passively managed long-term buy and hold ETF is on the high side. I have a hard cap of 50 basis points. This would be higher than anything I hold, but it's not horrible and it's definitely produced results. We'll get there soon. And it's AUM, the assets under management, have ballooned to 27 billion. That's pretty cool to see. I've been watching this one for many, many years. I guess this number is going to balloon when the returns are so astronomical. But this thing is not going anywhere. Now I'm out on the holdings tab, and on the holdings breakdown, of course, this bad boy is 100% technology when we know it's 100% semiconductors. And looking at the names of the top 10 holdings, you have Nvidia, which I would imagine commonly has been creeping above 20%. This will be rebalanced quarterly. And then you have a bunch of other major players here. I won't read them all, but these are all names that most of us have heard about over the years. And the top 10 names add up to 74% of this bad boy, which I guess isn't crazy because it does only hold 25 of these things. And of course, it's going to be a little top heavy naturally, but still, all your eggs are really in this basket. That's for sure. All right, we're going to skip right over the dividends tab. Now, you all know I love my dividends and dividend growth, but in this one, let's call it what it is. We don't care about dividends for these growth monsters. We want to go to the juicy charting tab. And you can see I've already pulled up some tickers here. I'm on the year to date. Now, this thing is set for total returns, so dividends are included. And of course, I have SMH because we're at its party after all. I put in my favorite 100% technology ETF, VGT. And then I put in what I think the masses out there of you watching will consider your go-to growth ETFs. These are multi-sector ETFs of SCHG, QQQ, and VUG. And we have to use QQQ instead of QQQM because we need the full history as we zoom out. And then of course, I always like to compare everything back to the market, which is roughly 50% growth, 50% value. So this one's gonna get spanked. I haven't looked ahead yet, but we all know that. So here on year to date, SMH, and it actually got off to a tumultuous start. And I'm looking down at the chart below. I can't move my mouse, otherwise it'll disappear. But you can see in April or so, it was the lowest on the year, but it's bounced back with a vengeance, as it always does. And it's now up 17.69%. Nice. Putting it well ahead of second place, which is QQQ at an even 10%. And then you have VGT and VUG battling. VU is up 8%, so the market's battled pretty well against the growth. And SCHG, of course, I bought it, so it wants to make me look stupid, at about 7%. When we zoom it out 1 year, this one actually looks a little less favorable for SMH. So over the last year, the total return has been 11%, and it looks like the big dog is actually VUG, which is the old man on campus here, over 30 years old, at 19%. And then the other favorites, VGT, SCHG, and QQQ, come in at 17%, and VU begins to trail a little, and I'm sure we'll see this trend continue when we click on the 3-year. And oh my gosh. So SMH is up 157%. And second place is comfortably under 100%. And that's VGT at 97. And then you have SCHG actually right on the heels of VGT. They're at 94. And then we have basically a two-way tie between QQQ and VUG at 89%. And then the market, of course, starts to lag. It is still a very solid 66% over 3 years. I'll take it. Zoom out 5 years. Now you're going down. Oh boy. 261% returns over 5 years for SMH. Second place is comfortably VGT. So usually this one's puffing its chest out around all these guys. Like, yeah, guess who runs this? 142 is a smaller number than 261, according to my amateur math. So VGT is walking a little more chill now. And you have SCHG at 124. Man, that's really impressive. Ahead of QQQ comfortably, which is at 118. And then VUG bringing it up the caboose at 113 as far as the growth ETFs. And of course, the market's trailing at a still very impressive 107%. That's a nice CAGR there for the S&P. And the most we're going here is the 10-year. And holy cow, SMH 1,165% to second place is normally enormous looking 602% of VGT. Wow. And then QQQ steps up and actually crushes SCHG in this one, 444 to 366. And then VUG is usually kind of nipping at the heels of SCHG, but never quite as good at 346. And the market, again, very impressively compared to our 100-year average, with a CAGR that's 3 to 4% better than that average, is up what seems to be here next to these big boys, a measly 257%. So all we have to do is retroactively know that SMH is going to dominate, rewind the clock 10 years and put all of our eggs in that basket, and boom, home run. Okay, we're not done with this section quite yet. I apologize. I completely forgot to add the best semiconductor competition, which is SOX. We are going to run through these very quickly, okay? Year to date, SMH is ahead 18% to 13%. Over the last 1 year, SMH is up 11%, which was behind these ones, but SOX is flat. So that's actually impressive by SMH by comparison to a like comp. Over the last 3 years, 157 for SMH to 92%. It's funny, VGT actually beat SOX on that. Over the last 5 years, SMH is that 261, which we already saw, to 167. A little more impressive there by SOX. It starts to run away from VGT. And then over the last 10 years, that ridiculous 1165 versus 842, which is now crushing VGT. SMH has absolutely dominated the competition. But the big question isn't just how it's performed, it's whether it's the right play for you. Portfolio fit. If you've been around the channel for a while, you know I'm a big believer in a balanced portfolio. I dollar cost average into my target allocations, and that only works if you're holding a good mix of value and growth. SMH, in my opinion, is only for investors that have major conviction that semiconductors will dominate the future. Past performance means diddly squat when you're buying today, and concentration risk is real. I do think that SMH has massive staying power, but I wouldn't recommend it for most buy and hold investors. Personally, I would stick with SCHG, QQQM, or even VGT for more broad growth exposure over the decades. But if you do roll with SMH, I'd strongly suggest pairing it with some high value plays to balance things out. That kind of counterweight becomes crucial when the growth train crashes, and let's be honest, it will happen. And when it does, for the love of all things, don't sell low, stick to your plan, stick to your allocations. Now let's run the backtest and see how wild this outperformance really is. SMH versus the top growth ETFs. I usually view these results live for the first time as I record these videos. I've always enjoyed keeping the screen shares unscripted. It gives you my real-time, authentic reactions. But I'll self-report here. I peeked ahead. I'm less familiar with SMH compared to the usual suspects, and I wanted to make sure we could pull a solid range of data. Turns out we can. Just over 15.5 years for today's mix of ETFs. And the results? I'm not sure if I laughed or cried, but I made noises. Let's check it out. We're out here on Portfolio Visualizer, which is a great tool for running these back tests, but it's very expensive. I do pay for it specifically for this channel. This is one that I would not pay for if I didn't have a YouTube channel, because the free version gives you 10 years, which is solid. But in this case, we'll dive deeper than that. So you can see here as Portfolio 1, we have SMH. And Portfolio 2, we have VGT, again comparing a sector of tech against technology. Portfolio 3, we have SCHG, which I think is arguably the best all-around multi-sector ETF. You could also do QQQ. And then for the benchmark, I use SPY just because the age of VU. I don't want to cut off the data. And that's the S&P 500 just for some context. And this just shows what I just said, SMH Portfolio 1, VGT Portfolio 2, and SCHG 100% of Portfolio 3. And before we hit analyze, let's pop over to the settings. Out here, we have the time period of 2010 through 2025, including year to date, just over 15 and a half years of data, which is nice. We're starting with $10,000 and contributing $500 per month to give this a realistic, DCA type scenario. And then the rebalancing doesn't matter because it's only one holding per portfolio. Reinvesting dividends, yes, to find the true total return and get our ending CAGR. And I think that about does it. So when we hit analyze here, we see here that we're looking at the period from January 1st of 2010 through July 21st, which as I record is yesterday, 2025. I'm just in this one. So we start with 10,000 of each and we put the $500 a month in. Keep in mind for only just over 15 years, you end with $1,153,000 with SMH. And VGT, which has obliterated the market, you end with merely $700,000. SCHG gets you just over $500,000. And the market, which has done incredibly well over those 15 and a half years, believe it or not, ends at $384,000. I can't. And so we'll get into the return information later. This is where this, in all seriousness, is a bit of a sore spot on SMH, and that's the standard deviation. The higher this number, the more volatile this bad boy will be for those huge downswings. You can see the market here, the SP 500 is about 14 and a half. VGT is usually ultra high at 15 and a half. Something like SCHG is right between it and the market at 16.6. Yeah, SMH is nearly 24. And then the Sharpe ratio, you want these higher, kind of interestingly lower than VGT. The Sortino ratio, same thing. This is the risk-adjusted return. I'm actually a little shocked by that. I didn't look at this when I did my little test. And then the benchmark correlation is going to be, of course, lower to the market, which is 1. These are more similar, and this makes perfect sense. SCHG has more balance and is closer to VU than VGT, which is closer than a little subsector of VGT. And one thing to note on the annual returns here is that SMH is the blue one, VGT is green, you have gray with SCHG. But you can see that year by year, we won't go over all these in detail, they do trend together. When the market's up, generally speaking, these growths are up. And the same when the market's down, like here in 2022. And you can see SMH was down more, makes sense. And when it's up, it's generally up more. That also makes sense. And I think the thing that gets a little deceptive, especially for newer investors, we are on a massive bull run, the third biggest in the history of the market. So this can be deceptive when you see this in the triple leveraged and even Bitcoin. I know the correlation isn't perfect there. Things are just going up. So things with high standard deviation have become a quote unquote good thing. But when the market flips, we'll see the same on the opposite. Kind of like this. The market lost you 18%. That's a gut shot. SMH loses you a third of your net worth in that same year. Past performance isn't everything is the only point I'm trying to make here. But with that said, let's check out this past performance because this is absurd. Let's focus here on the annualized return, the annualized CAGR here for each one. So over the full 15 and a half years, SMH has an annualized return of 22.5% compared to second place VGT of 18.6. Over the last 10 years, it's up 27.6%, good Lord, compared to 21.4 of VGT. And the market still, again, very impressive, over 13 in both time horizons. And in the last 5 years, okay, I'm just seeing this stuff for the first time. I can't say this with a straight face. 30% CAGR. Over the last 3 years, 41% CAGR. And I'll let you kind of look at the normal stuff. I mean, even the market is up almost 20% over 3 years. We're on such a massive bull run, it's a little frightening, to be honest. And then over the last year, it has struggled by comparison to these other ones, you know, because it's going to be up and down with the high standard deviation. But these return figures are just astronomical. And I would say 15 and a half years is a nice little sample size here to get you well over 20%. And the last thing I'll point out is the SMH here on the style analysis has a PE ratio that's a lot lower than I thought it would be. We won't go over all of them, like the competition here, but I know VGT and SCHG are both higher than this. I found that interesting. And here's that expense ratio. It'll hurt a little bit. Your yield, we don't really care. It's like 0.4%. As I scrolled through all the stuff and decided what to waste more of your time with, I was a little shocked by this. I might look more into the reasons why this is relatively low after I make this video. There it is. It's a monster. But buy at your own discretion and keep that portfolio balanced for the long run. I genuinely wish you nothing but the best for your investing future. And speaking of the best, a huge shout out to the 4 of you that joined the channel membership over the last couple weeks. We had 3 new members. Welcome Daniel, James, and TFX. And then I'd like to welcome back Blaine, who rejoined the membership that he had before yours truly canceled things. And I've said it before, it really is my favorite type of support because I don't have to go out taking sponsors I don't actually care about, and it's as authentic as it gets. So never required, but you are much appreciated. Check out one of these 2 videos to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I will see you in the next one. Peace.